Hello and welcome to SAMT AG webinar on cryptocurrencies, all you need to know. Now the reason I call it all you need to know is because even though you will know the fundamentals of it, that would be more than sufficient to take a step back and evaluate the social media news and not get carried away with the trend. So the purpose of this webinar is to make you an informed investor regarding cryptocurrencies. Let's dive in. Now, before we start, let me introduce myself briefly. My name is Nael Shahbaz, and I am an MBA in Insurance and Risk Management, currently the business manager of SAMT AG Switzerland, the asset management company. And it's my job to evaluate the markets and the trends, so that qualifies me to educate you about cryptos. Let me give you a quick overview of this whole webinar. So we're going to start off with the introduction of the cryptocurrencies and check out the platforms where the trading takes place. Then we're going to move to studying and trying to find out the fundamental value of the cryptocurrencies and try to see if this cryptocurrency trend is a financial bubble or not. Then we're going to look at the possible outcome of the cryptocurrencies, and we're going to look at a little bit of historical examples of similar trends, what happened to them. And last, we're going to look at a better alternative for retirement. And this is especially for those people who think that investing in cryptocurrency is a good retirement planning. So the whole webinar is probably going to come under 30 minutes. So what are crypto coins? A cryptocurrency is a digital asset. Now the stress is on the digital. It is not tangible. So whenever you hear the term coin, it's not a hard coin. It's a computer code. And Bitcoin was the first decentralized cryptocurrency. It was developed in 2009, and since then there have been many. The reason for creating digital currency such as the cryptocurrency was to create a medium of exchange that was free from banking policies or government influence. Now, I understand that the production process of cryptocurrencies is sort of a mystery for common people. And the concepts such as the miners or the developers is a little alien. So what happens is that a coin is just a reference term, so it's not a hard coin. It represents an agreed on record of an ownership. So that's what a coin is. So it could be a Bitcoin or Ethereum coin or a Litecoin or a black coin. There are so many. These are generated by miners or computer programmers. And the proof of work is something that represents a coin. It's a little bit complicated, but just understand this, that a computer code refers to a coin and it is produced by programmers. And these are produced on demand. They are not dependent on import-export of a country. So if more people want to buy a certain cryptocurrency, more will be produced. Simple as that. At the moment in 2017, there are over 900 cryptocurrencies, and the reason that you have heard the name Bitcoin so much is because it was the first decentralized currency. It made the concept of cryptos popular, and it is the largest market among the crypto coins. It's probably over $80 billion market right now. And following up are the other minor crypto coins, which are Ethereum, Ripple, and Litecoin. By the way, the term altcoin was specifically used to refer to any alternative of the Bitcoin, but these days they are mostly used to represent really new and minor coins such as DigiByte, Dash, and PivX. So these are relatively new. Some have just been launched in the past couple of months. So the Bitcoin is number one, with Ethereum, Ripple, and Litecoin following up, and then there are the other altcoins. If you're interested, you can go to bittrex.com. It is one of the major exchanges for cryptocurrencies, and check out all the other crypto coins. So the one that you're looking at in this slide is from the Bitcoin markets. Similarly, there is the Ethereum market and the list of currencies for the Ethereum. You can use the coin Ethereum to trade in the other currencies such as Litecoin, Golem, Sia Coin, and so on. But the majority of crypto trading takes place at Poloniex.com, and this is the main interface you're looking at with the altcoin XCM graph showing. You can start trading Bitcoin in 3 simple steps. First, you need to set up a wallet. Again, just like digital currency, wallet is not tangible. It's just a place on a website where you keep your digital currency. Coinbase.com is the most famous. Number two, you put your currency, your dollar or euro amount into your wallet at coinbase.com. So you connect your payment method, say your bank account, your card, to coinbase.com and convert your currency like dollar euro into either a Bitcoin, Litecoin, or Ethereum. Number three, from here on, you send your converted currency like Bitcoin, Litecoin, or Ethereum to the exchange. And the major exchanges are Bittrex or Poloniex. And when you have sent the currency at the exchange, here you can start trading. This is the main interface at Coinbase.com. You set up your account, prove you're not a robot, validate your email, your phone number, and you will be given access to your account. After creating your account, this is the main interface. So Bitcoin is selected by default, and you can see the changes since last month. And the tab on top, you see dashboard, buy, sell, send, accounts, and so on. But then you need to connect in the buy and sell tab your bank account information or card. So you could send your currency, your dollar, your euros here, so which are converted into the currency of your choice. So you choose either Bitcoin, Ethereum, or Litecoin for conversion. After you have sent money in your Coinbase.com, now you have created a wallet. Now from this wallet, you are going to send money to the exchange of your choice. So in this case, in this example, we're going to choose Poloniex. So in this recipient bar, you will enter the Bitcoin address or the email address of your exchange, and the money will be sent to that exchange. So here we are at Poloniex.com, and assuming you sent Ethereum from your wallet at Coinbase.com here at Poloniex. So you will be using Ethereum to trade other altcoins. This is the main interface. When you make an account, you will need to get used to the different tabs. This highlighted part is just a snippet of the selected currency, which is LSK. So we can see the 24-hour change is 12%. That's very, very normal. It's quite volatile, so seeing 30 to 40% change in 24 hours is expected. You scroll down a little bit and you will see this tab of buying and selling. Here you will execute the orders. You can enter the desired buy price, which you want to buy at, or by default, it will show the current buy price. Similarly, on your right side, there is the sell side, and by default, it shows you the current selling price. You can put your desired selling price in, and as soon as it hits your desired one, it will execute the order. If you scroll down on the same page, you will see the current market activity for the selected currency, which is LISK in this example. On your left side, you see sell orders. So if you see a price tag that you like, you can go ahead and buy it immediately. Similarly, on your right side, you see buy orders. You see a price tag, you can go ahead and sell at that price. The real question, as an informed investor, a prudent, a rational decision maker, is what is the real value of cryptos? For instance, you strip away all the hype, all the media attention, and all the trends and success stories. What's the true value or the fundamental value of cryptos? That's the real question. It is a little complicated to establish the fundamental value of cryptocurrencies, but it is a medium of exchange. It is a currency, so we can compare it with, say, US dollar for the sake of argument. But the US dollar derives its value by exchange rate, treasury notes, and measuring it against foreign exchange reserves. But the problem is that cryptocurrency, or even Bitcoin, they don't have this luxury. They have their benefits, but it doesn't explain their price. And especially now, the Bitcoin is approaching $3,000 per coin. How do you explain its fundamental value? And the problem gets even more complicated when you try to define exactly what a Bitcoin token really is. So if you compare with the price of making one Bitcoin, that's just the electricity consumed over 1 month to make one Bitcoin, which is just establishing a code by the miner. So where does the fundamental value lie? Legitimacy is extremely important. if you want to establish the fundamental value of an asset, you have to establish its legitimacy. The problem with digital currency such as Bitcoin is that its value is not backed by any government or central bank, and the only value is derived by a software which only a few people truly understand how it works. So this gives the opportunity for scamsters to do whatever they want. It is an open, fertile ground, and especially with exploiting social media. As an analyst, it is imperative that we study the current price of Bitcoin and see what was the reason behind such great jumps in its price. And the answer is it was mainly based on speculation. The media craze with coin and digital currency back in 2013 and 14 got the whole world interested in it. And based on this curiosity, where people wanted to know more about it, it started the speculation saga. And now it's approaching $3,000 for one Bitcoin. One byproduct of the speculative success of Bitcoin has been that the startups have seen an opportunity of raising money very quickly. And in certain instances, it has been just a matter of seconds that they have raised millions of dollars. So what they do is they issue a digital currency of their own. It is that easy at the ICO, which is the initial coin offering. So people see that as an opportunity of making quick money. They think they're buying these coins at dirt cheap rates, and within a matter of few months, they will cash in a lot of money, making profits on it. As far as the utility of these coins is concerned, think of them as Disneyland dollars. So you will be able to utilize or use these dollars within a very limited ecosystem given by that startup. You probably won't be able to put gas in your car or pay bills. And as far as the other perks that these startups promise in return for these coins, those marketplaces and businesses are yet to exist. So the utility, the real utility of these coins exist in the future. Other than the people who seek an opportunity of making quick money, college kids and people who play computer games, they're getting interested in cryptocurrencies because they have a little bit of money in their pockets and they see an opportunity of buying these altcoins in the hopes that in a matter of months, they will make a great profit on it. Now, when the success of an asset is based purely on speculation, this is an indicative of a bubble. A financial bubble occurs when the value of an asset is way above its fundamental value. And right now, cryptocurrencies, the trend, the historical jump and climb in its price, it's screaming that there's something wrong that needs to be evaluated rationally. One might argue that calling the cryptocurrency trend as a bubble might be just an opinion, and I agree, which is why there has to be a set standard where a trend can be evaluated to decide whether it is a bubble or not. Which is why I bring in Hyman Minsky, who was relatively unknown prior to the 2008-9 financial crisis. But his theory of financial instability perfectly described what a financial bubble looked like. So, let's go point by point and evaluate whether the cryptocurrency trend is a bubble or not. So the first stage in a typical credit cycle is displacement, and it happens when investors see or encounter something innovative, something new, and usually it's some new technology, or it can be some jaw-dropping interest rates. And if you look at cryptocurrencies, they are textbook examples of displacement. They offer innovative technology. In fact, they were created back in somewhere around 2009 as an alternative for the usual currencies and a medium of exchanging, conducting business that was free from banking policies or the influence of government. So that's the first step. Cryptocurrency qualifies as a perfect displacement. Well, the second step is the boom phase. And what happens is initially the prices are slow to rise because something is new and people are curious but also skeptical. But as soon as the momentum picks up, media picks it up and the media starts talking about it as if it is something that everyone needs to know about. And that's what happened in 2013 and 14. Media coverage shot up the price of Bitcoin. And that was the boom. Next comes the phase of euphoria. So what happens here is the prices of an asset reach their peak, and everyone who's getting curious or interested in investing in it is having the same thought, that they do not want to miss out on this great opportunity of making money. Now in 2017, this is probably the phase of euphoria for cryptocurrencies, because prices have already gone way up above their fundamental value, and people are investing money like crazy in it because they do not want to miss out on this opportunity. The fourth stage is of profit taking, when people start selling because they want to make profit from it. So they're not buying to hold it in the hopes that the asset will go further up in price. They know it's going to go down. It is difficult to assess exactly when the bubble will burst, but this phase, when this hits, people start to make as much money as possible on their assets. And then comes the final stage, panic, when the price of the asset takes nosedive, and every investor, they literally start to panic and they want to sell the asset at any price they can. They want to liquidate it immediately. Now, as an investor, the most important question is, what does future hold for cryptos, or what will be the outcome of an asset that's clearly overbought? Now, science tells that history predicts future. And we have many examples of investments that didn't have any fundamental values. And all cryptocurrencies will go the same way as other investments that didn't have their fundamental values. The assets that only grow if you find someone who can pour more money. So it's kind of like a Ponzi scheme. Let's take a look at the bubbles in history and see if we can find some similarities. There was the South Sea bubble of the 18th century, the Mississippi bubble of around the same time, the railway mania of the 19th century, but the most famous bubble was of the Dutch tulip mania of the 17th century. Now, take a look at this graph. Now I'm going to compare it with the graph of the rise in the Bitcoin price over the past few years and see if we can find some similarity. This Bitcoin price graph looks almost the same as the graph of the tulip mania. Now, let me ask you this. Did you collect beanie bags, stamps, Kinder Joy, and discover that they have zero value now? Or, let me rephrase, what have all the bubbles in common? The answer is that they run on things without a fundamental value, and they occur when the market is liquid and people have money in their pockets. Let's understand. For investment, fundamental value is crucial. Fundamental value means that the asset you invest in has real value that's valid even without selling it. For example, the real value of an asset is that it produces goods and pays dividends. The real value of a house is that you can live in it or get a rent payment. And the real value of oil is that you can heat your house or drive a car. But in bubbles, the only value comes from selling the asset to someone else for even more money. Today we laugh at the tulip buyer of the 17th century, but our children will be laughing at the cryptocurrency buyer. As soon as the interest rates go up, all the crypto investors, they will start asking for their money back, and many billion-dollar startups, they're going to declare bankruptcy, and a bank run will start on cryptocurrencies. And this will happen in less than a decade from now, maybe in the next couple of years. I'm not against cryptos. You can trade them, but understand this, that their value, all of their value, will become zero, and you should seek to get out of the market before that happens, before the panic starts to set in. I know that some early birds have made a fortune with cryptos, but most mass adapters, like the one who are looking to invest now, they're going to lose all of their investments. There are journalists out there who think that investment in cryptocurrencies is similar to investing in a pension fund or an investment in your retirement. But one thing is certain. It is not a retirement saving when it depends on hype, and cryptos only depend on hype to grow their value. Understand this, that gambling is not retirement planning. A successful retirement has attainable savings, and there has to be a reliable investment plan, and this is very, very important. And after that, there has to be a commitment to sticking with the plan. For instance, Module 1 at SAMT AG, it's perfect for retirement planning. Now, we have fine-tuned the modern portfolio theory. So our long-term lasting core strategy is developed in such a way that the positions they don't need to be changed for a long time, and under normal circumstances, reinvesting dividends is enough to adjust the assets. Now, you're looking at this graph. It shows our wealth management approach and how it works. So what we do is we choose and combine ETFs in such a way that the result of this combination delivers a superior risk to profit profile when you compare it with a single ETF. So when you look at the other asset managers, they might offer diversified products, but the combination that we provide, it is developed with sophisticated optimized algorithms. Let me give you another example of our scientific concept. This graph that you're looking at compares the Dow Jones Dividend ETF with SAMT Core Portfolio. And this comparison is from the late 2010 to late 2016. Both perform almost the same, but the difference can be seen during the period known as the Greece sell-off, which was around August 2015. Let's take a closer look. The Dow Jones lost 531 points, and SAMT Enduring Core ETF lost almost nothing. And this is because the way we have built and optimized the SAMT Enduring Core and how perfectly it's diversified the way a retirement plan should be, it is built to last and endure over many years in the market. And that's why it behaves more stable than other options. Okay, keep in mind that SAMT Enduring Core is not optimized in a way that it reacts actively to stocks or bonds or market movement and changes its composition of the portfolio. It's optimized in a way that it endures without any changes in bad or good times. When other asset managers might try to time the market and might miss it or even over-optimize, our asset management approach is made to endure through times without any changes. If you would like to know more about Module 1 or about our other modules, you can log on to our website. That's en.samt.ag. Again, you can reach me personally at Nael, that's Nael, at samt.ag. Thank you so much for watching. I hope I have been of help to you regarding cryptocurrencies. I hope to see you soon. Take care. Considering the volatility of cryptocurrencies, it is definitely not a good choice for a sound retirement plan. A retirement plan has to be reliable because in old age, it's not feasible to take risks and be subjected to violent price swings of your invested assets. The modern portfolio theory is mainly used to determine asset allocation in a portfolio, and generally, there are 5 to 10 portfolio choices available to an investor. Harry Markowitz, an American economist, presented an essay on modern portfolio theory in 1952. He received Nobel Prize in economics for it, and the findings of this essay substantially changed the perception regarding asset management and risk. This theory is still considered a cutting-edge solution for effective portfolio management. The two main features of this theory are, for any investor, the goal is to maximize the return for a given level of risk, and 2, the risk can be reduced by making a diversified portfolio unrelated assets. The reason for including explanation of this theory is to dispel the myth of investing in cryptocurrency in the hopes of creating reliable retirement savings. The other name for using this approach of modern portfolio theory is passive investment. Without complicating the concept of portfolio theory, understand that the objective of this approach is to build the right risk to return portfolio for a broad range of assets that have substantial value. This approach is less exciting but also less frustrating as the emphasis remains on reliability, where your investment stays relatively secure regardless of the day-to-day changes in the market. And considering the price change graphs of cryptocurrencies that resemble a roller coaster ride, investing in digital currency is anything but reliable for retirement savings. Let's briefly define risk and return. Return is the appreciation and price of an asset, just like the increase in a stock price. The return also includes any capital inflows such as dividends. Standard deviation is a means to measure the risk because an investor ideally seeks to have steady and gradual increase in the price. Extreme jumps in price can be dangerous because they normally indicate volatility. And as we have seen in the case of financial bubbles, big swings can also end up in losses and extreme losses. Another way to look at standard deviation is the range in which the price of an asset varies on average. For instance, if the price of an asset shows 10% deviation from the mean with average expected return of 8%, the investor can observe the returns between -2% and 18%. To give you a practical example of Markowitz's portfolio theory, let's assume that there are two portfolios of assets with an average return of 10%. Portfolio A has risk or a standard deviation of 8% and portfolio B has a risk or standard deviation of 12%. Both portfolios have the same expected return, and any investor will choose to invest in A since it has same expected return as of portfolio B but with lesser risk. Now this is the reason you need to understand risk as an analyst, because there is no expected reward without risk. Investors get compensation for bearing the risk, and theoretically speaking, the higher the risk, the higher the return. In our example, it might be very tempting to presume that portfolio B is more attractive than portfolio A, since it has a higher risk at 12% and a potential return of 22%. But there's also the possibility that it will return -2%. Provided that all things remain equal, it's still preferable to hold the portfolio with the expected range of returns between +2% and +18% because it will more likely get you closer to your financial goals. Risk, as we have seen above, is a welcomed factor when investing because it allows us to reap rewards for taking on the possibility of adverse outcomes. Modern portfolio theory, however, shows that a mixture of diverse assets will significantly reduce the overall risk of a portfolio. Risk, in other words, has to be seen as a cumulative factor for the portfolio as a whole and not as a simple addition of single risks. Assets that are unrelated will also have unrelated risk. Now, this concept is defined as correlation. If two assets that are very similar have similar characteristics, it means that their prices will move in a very similar pattern. For instance, two ETFs or two exchange traded funds from the same economic sector and same industry are likely to be affected by the same macroeconomic factors. In other words, their prices will move in the same direction for any given event or factor. On the contrary, two ETFs or two exchange traded funds from different sectors and industries are highly unlikely to be affected by the same factors. This lack of correlation is what helps a diversified portfolio of assets have a low risk, which is measured by the standard deviation, than the simple sum of risks of each asset. Without going into the detail, a bit of math might help explain why. Correlation is measured on a scale of -1 to +1. +1 indicates a total positive correlation, which means that prices will move in the same direction par for par, while -1 indicates the prices of these stocks or two assets will move in opposite directions. If correlation between all ETF pairs is 1, then it would seem reasonable that the total risk of the portfolio is equal to the sum of the weighted standard deviation of each individual ETF. Whereas a portfolio where the correlation of asset pairs is lower than 1 must lead to a total risk that is lower than the simple sum of the weighted standard deviations. The magic of building different pairs is that by different combinations, it's possible to achieve basically every risk to return combination, even different from the risk to return level of single components. The efficient frontier is like the backbone of modern portfolio theory. It was also introduced by Markowitz, and it's very easy to understand. The name might sound a little daunting, but it's very simple. It's the graphical representation of all possible outcomes of risky assets for an optimal level of return at any level of risk. The risk, of course, is measured by the standard deviation. Now, this chart here shows a hyperbola showing all outcomes for various portfolio combinations of risky assets. The standard deviation is plotted on the horizontal axis or x-axis and the return on the vertical axis, the y-axis. The straight line, also known as the capital allocation line, represents the portfolio of all risky assets and risk-free assets, which is normally AAA rated government bonds. The tangency portfolio is the point where the portfolio of only risky assets meets the combination of risky and risk-free assets. This portfolio maximizes the return for any given level of risk. The portfolio along the lower part of the hyperbola will always have the lower return and a higher risk, whereas the portfolios to the right will have higher returns but higher risk. Hello everyone. I hope you're enjoying the course or you've already finished it, but regardless of that, if you have any questions whatsoever, please don't hesitate to reach out. You can message me here privately, post it in the discussion, or you can even use my socials. I'm quite accessible actually. They are in my profile, so they shouldn't be hard to find. I've been reading your reviews. Thank you so much for those. Really appreciate them. And as a token of my appreciation, I want to tell you about our portfolio tool, which is free, of course. It's very easy to use and you can make and manage your portfolio with it. There's no catch or cost forever. I absolutely guarantee that. So this is the address you're looking on your screen. You simply visit the link, click the button here, and it takes only about 3 minutes to create your optimized portfolio. I'm very proud of our service, which is why I'm telling you about it. This is something really unique because usually tools like these are affiliated with banks or other financial firms. So what they do is they keep recommending you to buy securities that they're the affiliates of. We're not affiliated with anyone. So you can trade anywhere you want. Absolutely no restriction. Go ahead and try it now. All right, take care, you guys.